name is Ryan McIntyre. I'm the president of Maverix Metals, which is a precious metals royalty and streaming company. We have 148 royalties and streams today, 14 of which are currently paying. We expect revenue in 2022 of approximately $50 million US at 90% gross cash margin. And we're dual listed on both the Toronto and New York stock exchanges under the symbol MMX.
Good to have you back, Ryan. In fact, really quite timely, actually. There's been a bit of action in the marketplace. Equities are a bit quiet, not a bad time for royalty companies. And you've done quite a big deal with Barrick Gold. Who knew they needed money? Can you tell us about the deal structure, first of all?
Yeah, no, so about a month or so ago, we announced the transaction with Barrick to acquire 22 royalties from them in exchange for $50 million. So a pretty straightforward transaction from that standpoint. And the good thing for us is that we are focused on gold royalties and streams. And this was a package of multi-million ounce gold projects. So perfect fit with our strategy.
Right. Okay. But there's a few other moving parts in there. Skeena, for instance, we can tell us about that component.
Mm-hmm. Yeah, the flagship royalty in that 22 royalty package was the 1% royalty on Skeena Resources' Eskay Creek project. And so they just released a feasibility study recently on an open pit mine in British Columbia, Canada, that could produce about 350,000 ounces of gold a year for 9 years based on current reserve life. But there's plenty more beyond that, just based on what we see. And so if you look at that, that would add by itself 10% to our existing revenue base. But it is worth noting that actually in between us announcing and closing the deal, Skeena actually bought back half of that royalty for 17.5 million Canadian dollars. So basically a quarter or so of the purchase price for the Barrick royalty portfolio already got paid back to us.
Yeah, we actually spoke to them this morning. Would you believe they're in Singapore as we speak, and then heading off to Australia? Tell me about the construct of that. I kind of made a slightly glib comment there with regards to who knew Barrick needed the capital, but why would they need to offload this? Does it come down to sort of cleaning up of house? Is it kind of, is a good cost of capital for them in terms of being able to utilize this somewhere else? I mean, what do you put it down to?
Yeah, I think it's probably a few different things. Probably the biggest thing is that it's just a non-core piece of their business. So this is actually the 9th royalty portfolio we've purchased. And that's how we got our big shareholders like Newmont, Pan American Silver, Goldfields at one point, Kinross, is that they basically accumulate these package of royalties and really just doing exploration and development type work, but then often sell off the properties just given they don't meet their core criteria of building new mines. And so what they do is they end up with a bunch of royalties typically, and it sort of get lost in the shuffle there. And they basically sell them off, I would say more or less because they want to raise some money to some extent, but just because it's non-core and they don't want to worry about it.
Right. But if you look at the deals that you did before, you mentioned them in Newmont, Pan American Silver, and Kinross, there was a different type of structure. They kind of rolled those in, picked up a bit of equity.
Yep.
Barrick that's a 100% cash deal.
Yep.
Is that right?
Yep.
Right. Was it ever an option to roll that in, or was that, again, non-core for them?
Yeah, I think both of our preferences. So I think Barrick's preference was cash, and so is ours, actually. Our share price is down just like everybody else's in the space, and we have plenty of cash flow rolling in at the minute. Plus, we have a huge credit facility as well. And so we thought that it'd be a perfect time to use cash instead of issue a lot of shares at such a low price. So it was actually kind of perfect fit for both of us. And frankly, probably one of the competitive advantages we had in terms of approaching Barrick with cash. And I would say a lot of our other sort of junior competitors don't have that same advantage.
Right. Okay. And if you look at the mix, that basket that you picked up there, there's a lot of exploration, a lot of development, and I think there's one operating project there. How do you view or value something like that? And more importantly, how do we? Because the thing I look to is either revenue or near-term revenue. And by that, I mean revenue in the next couple of years or so. How do you say, well, that is a good deal, that is a fair price to pay?
Yeah, so we do a bunch of different things, but the main thing is, when do we expect to receive revenue and how much revenue do we receive? And so I think, Skeena's Eskay Creek project, the royalty there, that was clearly the flagship of that portfolio. And so, that alone, if you look at, how much revenue that would generate on a, 0.5% basis, what we have now, it'll be about just under 2,000 gold equivalent ounces per year. And so if you look at that in the revenue base, you're talking kind of around $3.5 million or so based on today's prices per year once that's up and going. And then you've got the other 21 royalties kind of behind that. And those are a little bit tougher in the sense in terms of timing. So the other three main ones to talk about are basically there are three multi-million ounce gold projects. So there's the 2% royalty on Bullfrog Gold Project in Nevada, 2% royalty on Lagunas Norte in Peru, and then you've got a 2% royalty on the Sanatura project operated by Samara. And so the good thing about all those is that they're all multi-million ounce gold deposits. They're all moving forward. Some of them are moving into production. Some of them are moving through the feasibility stages, and some of them are just in the initial stages of doing a preliminary economic assessment. So, those are a little tougher just due to timing. But the good thing about, gold assets and our ability to withstand time is that we contribute no additional costs. So it's really our time, but it's not necessarily our money going into the ground. And so, we're pretty favorable on that.
Okay, well, we'll come and talk about your cost of money in a second, but again, just sticking with the portfolio that you picked up, predominantly Australia, Canada, US. There's a few outliers in Peru, Burkina Faso, and Chile, etc. Again, the market assesses jurisdictional risk very differently, I think, right now. I think obviously there's a lot of economic risk, but there's a jurisdictional component where it feels like, tier one countries, it's getting harder to define because of permitting, licensing, environmental, and so forth. Does that allow you to have a different sort of value conversation with Barrick, or because of their kind of long cycle view of these things, it was kind of, well, that's the price?
Yeah, I mean, everything's a negotiation, obviously, when we're doing these deals. I think the thing is for us, if you actually look at the projects that we got involved with in this royalty package, a lot of them have historical mining pedigree. So Eskay Creek would be a perfect example. That's a past producer. Also the one Lagunas Norte is a past producer and actually moving back into production now. And Bullfrog similarly was a past producer and in a jurisdiction now that's basically being consolidated by AngloGold in Nevada. And so really all really mining pedigree areas. And that's where we really want to stick as a business. Because as you point out, it is getting a lot tougher to permit. Timelines are extending, the cost is going up. And so I think you really want to be in jurisdictions that can go through the permitting process successfully.
Right. Okay. And talking of balance sheets, etc. So, what's yours look like in terms of the mix of money that you've borrowed or got on the books or are generating?
Yeah. So right now, after the Barrick acquisition, we have about 18 million in cash and about 46 million in debt. So net debt a little bit, but not too much. So very easily to manage.
Right, easy to manage, but if you're going to do another deal like this, you probably need to go and draw on some credit facility or that. Even for you, that's going to be expensive or more expensive in a climate like this. Does that sort of adjust your thinking in terms of being able to take advantage of a situation which may come up, or do you think actually this is very much a long-term play and therefore the kind of cost of capital now may seem out of whack, but it's actually cheap money?
I think one of the good things, at least about our situation, is that we have readily accessible cash via a credit facility. So we have a $160 million credit facility, and we have almost $120 million remaining of it. And the great thing about that is it's done by the four large banks in Canada. And so we're getting rates of LIBOR plus 1.9 to 3%. So I think from that standpoint, we have a solid base in terms of quantum and cost. And then the other aspect is that we're also generating significant free cash flow currently, right? With 50 million of revenue at 90% margins this year. So substantial cash coming from that. But I think you hit on a good point because, it is relatively recent where rates have gone up a lot, right? And so clearly when we're evaluating new acquisition opportunities, you do have to factor in that higher cost of capital. And I think that's what you are seeing, with a lot of, I would say, acquisitions right now. Our desired rate of return has moved up slightly, just given our cost of capital has moved up slightly. So that's what I would anticipate from other players as well. And so it should be no surprise that it should match the cost of capital.
Right. Okay. You're dealing in long life of mine projects. So one would hope that kind of equals itself out over time. But the other thing that is potentially happening at the moment with producers is that their costs have gone up. right? And we've spoken to a few who have said, you know what, we need to kind of manage this because they get pressure, getting squeezed from the top as, say, precious metal prices come down, costs are going up, margins are smaller, and they're slightly adjusting their output plans, or certainly their expansion plans on production. So again, does that kind of, you've got to factor that into what you're projecting and guiding the market as well?
Absolutely. Yeah, I think, one of the positives, obviously, with, being, allocated towards gold mines in particular, given that that's really the primary base of a lot of our paying assets, is the positive side is, if the gold price goes up, you'll get more immediate cash flow. But the side benefit, as you point out, both positively and negatively, if gold price goes up, you're very likely to get additional resource expansion, maybe throughput expansion. But that goes the other way as well on the downturns as well. And so if there's a lower gold price, you could see actually the deceleration in terms of timelines. But I think the great thing about, the royalty business, and particularly the way, we're approaching it, is that you're naturally basically counter-cyclical when you're investing. And so albeit, gold prices are down, but also the prices for royalties are coming down a little bit. So we're seeing a lot of opportunities to deploy money over the long term and get great exposure. So when the next cycle kicks in and gold price starts going up again, we're perfectly exposed to that rising gold price with immediate gold price reaction, resource expansion, maybe throughput expansion, and then maybe some acceleration in some of the projects. And so that's exactly what you want to do in these downturns.
Yeah, well, that's the exciting bit, isn't it? Right? Because these are the moments of opportunity because your cash flow should be steady for you because you're not affected by the cost. You're not putting the cost into these mines. You're taking the net position on them. But there are deals, they're cash constrained companies. I mean, even a Barrick is cleaning up house a little bit there. Do you think therefore we should be getting a bit more credit? Because again, the pressure, given a bit of pressure on your share price, like everyone else at the moment. But given it's counter-cyclical, should you be getting credit for that?
I would like to think that we'll get credit eventually if we don't get credit now. Because what we are really doing is we are really building a long-term portfolio here. And I can tell you as a management group and as a board, we're not looking for immediate satisfaction day one. But we're thinking, 2 years out, 3 years out, 5 years out, 10 years out, and how are we going to layer this portfolio in to take advantage of what we think will be rising gold prices in the near to medium term.
Right. Okay. So hopefully we'll see what you're able to do, what opportunities appear over the next few months. And you've got to have a view again as I don't want to go too far this way, but your view on the economy, it's been a tricky year. The kind of normal rules don't seem to apply somewhat. So your take on how long this pressure will remain on precious metals?
I think a lot of it will depend on the central banks around the world. So for the U.S. in particular being the big one, you'd have to assume they're going to continue to raise rates for the next little bit. But at some point, that will become untenable, I would suggest. You're starting to see some cracks in the market already. But more than that, I think people's expectations for the economy, which really, at the end of the day, will probably drive the rates and inflation and so forth, those will start to come down. And once those come down to a level, they can probably take the foot off the gas on rate hikes. And I think that's the perfect time for gold to perform well. So hopefully in the next 6 months or so, we'll see a shift in that behavior.
Right. Okay. And I better finish on another high, which is continuing to pay dividends. That's not affecting your shareholders. Then the current market. What did you forecast? 1.25%.
Yeah. So right now we're paying about a 1.5% dividend yield based on today's share price and dividend, and we'd expect that to be fully sustainable. And as our cash flow continues to grow over the next several years, I would anticipate the dividend per share to grow as well. So I think that's the great thing about us is you've got, cash flow coming in the door as an investor, and you have the growth built in already to the portfolio, even if we did nothing else on the acquisition side.
How do you view M&A? Right, we obviously, I think recently Sandstorm Nomad deal. Some people excited, others disappointed because Nomad did not get a chance to fulfill their potential. How do you feel if you got approached on a takeover right now?
Yeah, we get that question quite a bit, I would say. They ask, how we think about the consolidation in the royalty space. And I think the best answer for us is that we're somewhere in the middle of it all, in a sense, because I do think that, we see ourselves as either the acquirer of some of these smaller companies that aren't basically meeting enough cash flow to pay their G&A. And then conversely, we could also be a nice tuck-in asset or a group of assets for a larger company in the space. And so I guess from our point of view, we're completely indifferent which way to go, but we're going to go which way's the better value for our shareholders. We're big shareholders ourselves, so we truly care about the shareholders in terms of the results and the returns they get. So we're going to do whatever we think is best for that.
Okay, Ryan. Well, look, I'll let you crack on. I know you've got a day ahead of you, and we shall speak to you soon. In fact, we are going to speak to you soon. You're going to come on and talk to us about contrarian investing in this marketplace in a couple of weeks. So I'll see you then.
Sounds good. Look forward to it.